Okay, hello. Welcome everybody. This is Lynne Celia. Let me know if you can hear my voice by perhaps raising your hand, or actually I can unmute, and if you can just give me let me know that you are hearing me okay.
Fine.
Oh, good.
I hear you on the phone, okay?
All right, good. And everybody can see my screen?
Okay here.
All right. Okay. All right, let's get started. I'm going to run through this and discuss the, well, let me introduce myself, Lynne Celia. I believe most of you know me from the Retirement Challenges workshop that I held at the Rec Center in February and March. And I thought I would follow up for the classes that I taught. And also there are people on this call that did not attend the class. But to really dive into the fixed indexed annuities and what we call the principal protection program. I would say the level that I'm talking at is probably, I would say, simple to moderate. I don't go into a lot of detail, but there is a lot of content. I'll try to get through it in about 40 minutes or so and leave time for questions and answers. Okay. All right, why don't we begin? Just a simple disclosure that this is really an educational class. I'm a certified financial planner, but this is not me giving financial planning advice. This is me giving education. If I were giving a custom tailored financial plan, we would be filling out documents, and I would be giving you certain forms, based on compliance, SEC, CFP board, etc. This is education. Okay, so today we're going to talk about the definition of annuities, the history, types of annuities, tax status, riders. Rider is a term for an additional benefit. Suitability. How do you know if an annuity is right for you? And what are the fees? What are the sales commissions and who pays them? What risks are there? Some other closing considerations. The haters. Now, this is a term my kids use. Don't be a hater, mom. Well, there are naysayers out there that really bash annuities, and I'll talk about that. I'll save my comments for when we get there, and then we'll open it up for Q&A. So what is an annuity? Well, in its simplest form, it's a contract between the purchaser and an insurance carrier. The risk is transferred from the annuity owner to the insurance carrier. And you pay a fee for this. So I think it's similar to where we can make a very simple analogy to our homeowners insurance, our auto insurance, our health insurance. We pay a fee and we hope that we never use it. And so there's a cost to transferring risk. With an annuity, we're basically transferring market risk, right? The volatility and the ups and downs of the market, something that we've all experienced over the past month or two. Longevity risk, based on all sorts of economic factors and your own genetic factors. How long will you live and will you have enough money? Economic factors such as tax rates, interest rates. There's a lot that goes into longevity risk. Okay. The history. Now, Really, annuities, this is so interesting, and I could spend a lot of time on this, but I won't. They date as far back as the Roman era, and really the first mention was recorded before the birth of Christ. The first one in the U.S. was a Presbyterian church that used annuities for retirement income for ministers and their families. And it was these annuities that really paved the way for all our benefits today for surviving spouses and orphans and et cetera. Benjamin Franklin, he was an early adopter. And when he died, he left 2 annuities to Philadelphia and Boston. And I forget which one, but I know that one of them lasted all the way up until 1993, when the city decided to take the lump sum at that point. They didn't want to get the regular payments. They wanted the lump sum. England used them during the early trade days with the colonies. And, it was basically to pay people for, I guess, the risks that they were taking, by moving to the new world. During the Civil War, President Lincoln used them for the military, right? To say thank you, those who got injured and disabled. But then President Grant came along and he said, oh, you know what? The benefits far outweigh the, what am I trying to say? The benefits far outweigh the contribution. And so he stopped them. And then the Supreme Court came along a few years later and actually restored the benefits for the soldiers. In the 1990s, the New York Stock Exchange used them. All sorts of things happened. The banks used to sell annuities, but then they were doing things that were not ethical in the sale of the annuities, so they were stopped from selling them. People were using them during the Great Depression, so on and so forth. Babe Ruth, he's somebody who everybody loves to hear about, and he put 100% of his money into annuities because he said, I take risks in life, but I'll never risk my money. So he's a really interesting guy. This is probably my favorite slide in the whole presentation. All right, let's jump into it. Types of annuities. Well, in its simplest definition, you have an immediate annuity and a deferred annuity. With an immediate annuity, you pay one premium. You plunk down, $100,000, right? And with an insurance carrier, and in return, they guarantee you a paycheck for life. And it begins the following month and it continues for your life. There are annuities that are called period certain, and you'll get a higher payout, but they'll only guarantee the payout for 10 years or 20 years, right? But the most common today are you get the payment for life. There's certain financial planning techniques where you would want to limit the payout to 10 or 20 years to get the higher payout. Your paycheck will stay the same amount or adjust with inflation each year. And here's where we talk about period certain, right? And there's, certain, that's where the financial planning comes into play, where you might say, well, do I want the income for life or do I just want it for the next 20 years? Deferred annuities are just what they say. The payment is going to come to you in the future, right? Now, with a deferred annuity, you can put the lump sum in and all that money starts working for you, accumulating and growing. Or you can spread it out. You can contribute to the annuity annually. But you do get to choose when you want to receive income. Okay, you can take income. A lot of the deferred annuities will usually make you wait 1 or 2 years before you can take income. Most common is 1 year. And any time after that, you can turn on the income. And the longer you wait, the more your payout will be. And some do require you to wait a certain amount of time before taking income. Now, very interesting, there are some carriers out there that will actually give you like a very sizable bonus if you don't take income for 10 years. There are a lot of incentives out there because annuities are products, and carriers want your business. So I don't believe we go into detail here about the incentives that are given and the bonuses that are given, but that might be for a next session. Now, a fixed annuity will basically pay the same amount for a set number of years, right? Fixed index is linked to a market index. Very important to know it's not invested in the market. It goes up and down based on one index or a blend of indexes. Some carriers offer many indexes for global diversification and asset allocation. For example, you could pick the S&P 500 and you could pick the NASDAQ. So, and you could allocate 50% to the overall market, 25% to technology, and you could even put 25% into a fixed account that earns probably 2 or 3%. Okay, but you're not in the market. The insurance company has your money, and they're doing things with it. You know, they're paying premiums with it, they're investing it, they're hedging, all to provide the owner of the annuity the guarantees and for them to make money. A variable annuity, honestly, these are the most complex, and they're really kind of what's given, I think, annuities a bad name with a lot of people. And some of it is actually rightly so. You're invested in the market and you use sub-accounts, which are mutual funds, ETFs. And they go up and down with the market, and the rates, the fees are very high, and they're incredibly complex to understand. We're not going to talk about them today. We're going to focus on fixed indexed annuities, which actually they're simpler and their fees are lower, and you know they really do the trick. You know, having done this for 40 years now. Although I purchased my first annuity probably 20 years ago, they've really evolved, like I said in class, like technology evolves. And so carriers are listening to the research, and they've really, I think with the fixed indexed annuity, they've created a hybrid where you get the market-like feel of a variable annuity with the lower fees and simplicity of a fixed annuity. So today we're going to focus on fixed indexed annuities. Now, what is indexing? Well, I think sometimes it's easy to define something by comparing it. So a traditional investment is invested in mutual funds and stocks. Most of us should know and realize that when you're invested in the market, the gains are unlimited. Oh my goodness, if the market goes up 25%, that is all yours. And along with that, so are all the losses, right? So you've got unlimited gains, unlimited losses. The owner of the fund, oops, I got both bullets coming in at the same time there. The owner of the fund or stock absorbs 100% of the market risk. Basically, they're self-insuring. They're saying, I can absorb this risk. Now, an indexed annuity, the market gains are limited. They're capped, right? If the market goes, you know, if you have a cap of 8% and the market goes up 10%, you're going to get 8%. However, if the market goes down 10%, you get zero. We call that zero is my hero. Okay, so the gains are limited with zero risk of losing principal, meaning you will never get back less than your original premium for the policy. So, and the easiest way to describe this is to run through a couple of scenarios. So, if the index is capped at 8%, what will your annuity make or lose if the market returns 12%? you'll make 8%. And if the market returns 6%, you'll make 6%. You see, you haven't reached the cap. So you're going to get, so anything 8% or below in terms of actual market returns, you're going to get. Above 8%, you're going to get 8%. So if the market drops 18%, you get 8%. I'm sorry, you get 0. That would be great if we could get 8% on a negative market. Correction, if the market drops 18%, you get 0. You don't lose any value. If the market drops 2%, you get 0. So anything less than 0 in terms of actual market performance, you get 0. Okay. Now let's take a look at a fixed indexed annuity in action. This is one that's using, the last 10 years of the market. And as you can see, when the market goes down, which is the yellow line, that's the actual S&P 500. When the market goes down in year one, the value of the index stays the same, 0%. Goes down again in the second year, 0%. The third year, the market goes up 14%. Right? I should say that this particular annuity has a cap of 14%. Now, I can't really say how old this slide is, but I can say that today the caps are usually based on the type of indexes you're in. So with the traditional S&P 500 index, you're going to see caps anywhere from 8 to 10%. If you're in the riskier indexes, your cap will go up based on the volatility of the index. Now this is pretty technical stuff, but do know this is just an example, but this is exactly how an annuity works. This annuity is invested in the S&P 500 index, or it's tagged to the index, not invested in it, tagged to it, linked to it, with a cap of 14%. So when the market goes up in year 3, goes up 26%, the most your annuity will be credited is 14%. And that's real money. That money is never taken away from you. So if you invested $100,000 here back in the beginning of year 1, and the market went down 13%, you would still have $100,000. In year 2, it went down 23%. You would still have $100,000. Year 3, the market goes up 26%. Your $100,000 would be worth $114,000 and will always be worth that. You're credited 14% or $14,000 in real money. The next year, the market goes up 8.9%, and that's below 14, you get it all. 3%, you get it all. 13%, you get it all because the cap is 14, and so on and so forth. Well, for these particular years, you actually have a 53% higher yield, even though you're capping the ups and limiting the downside. It doesn't work this way for every 10-year period. I think, for example, here our cap is high, and we only have a few years where we go through, we break through the 14% cap. And so the message is still the same though. You get 0 downside, you get complete downside protection, and you're capped on the upside, right? And in some cases, you will have more money than if you were in the market. Very, very, very good visual here, and then very important to help understand how a fixed indexed annuity works. So let's just use an example, right? So I'm a 60-year-old female. Not quite, I'm 58. But let's say I'm a 60-year-old female and I plan to retire in 5 years and I have 500,000 in my IRA. Now, the industry rule of thumb says that I could allocate my age as a percentage of my total liquid assets in retirement. So in this case, if this IRA is my nest egg, I have no other accounts, I could allocate 300,000 into an annuity. The other 200,000 I could invest in the markets, you know. But it also depends on, I mean, I would not put more than 60% in. You don't ever want to put all your eggs in one basket. And you have to sit back and answer a few questions and have to look at the total picture as to how much is the right amount to put into an annuity that's going to guarantee you an income for the rest of your life. But in this case, I'm a believer in them. I would put 300,000 into an annuity, and this is an example of an annuity calculator. And basically what this is telling me is I buy an annuity today with an insurance carrier and I give them my $300,000. I'm 60. Now, this particular carrier is actually, I own this product. And that's why I chose this one. They give you a 10% bonus for doing business with them. So immediately I'm given a $30,000 bonus. So my account on day one goes from 300,000 to 330,000, which honestly helps to absorb some of the cushion of recent market losses, I would say. And then based on when I take income, if I choose to take income at 65, I would get $17,000 per year for the rest of my life, guaranteed to never go down, but could go up because this particular annuity would adjust with inflation. Now, I haven't gotten to it yet in this presentation, but if I were to need long-term care assistance, if I could not perform 2 of the 6 ADLs, activities of daily living, it would double the amount. So instead of $17,000, I would get $34,000 each month for 4 years before it would revert back down. And I don't want to go into too much detail on long-term care, but you have to get into what is your gender, what is your age, what is your condition, and what is your average life expectancy. But it is an additional benefit that you can get that will double the payment basically for 4 years. So with this number, I can determine, should I wait a little longer? Can I wait 2 more years? And at 67, I would get $20,000 per year. Now, this is the guaranteed payment, but once you add indexing, see, these are just predetermined guaranteed payouts right here, benefit payout percent. But if I'm indexed in the S&P 500, for example, and the market does great, these values will be higher because I've given it 5 years to grow. Okay, I could spend a lot of time here, but I just want you to see, as a matter of fact, the next class I'm going to offer is actually walking through an illustration so that you know how to read them and what to look for. Tax status. Well, let's use the example we were just using, and I have 500,000 in an IRA. Well, that IRA has before tax money, right? It has before tax money. So if I were to roll that into an annuity, that annuity would be a qualified annuity. So all distributions at $17,000 per year would be taxed as ordinary income. Now, you could have, if I had that money in maybe a brokerage account, or a savings account earning 0%. That's what we call after-tax money, and that would be a non-qualified. If I rolled 300,000 from a savings account earning 0 into an annuity, that would be a non-qualified annuity. So just the growth, and then if I waited 5 years and it grew in value, when I take that growth out, that is taxed. So the least common denominator is that both of them allow for tax-deferred growth, right? The qualified allows for tax-deferred growth, and obviously your original investment would be taxed, but both allow for tax-deferred growth. So what a lot of investors do is they use them to get tax-deferred growth when they max out on their 401k or IRA. So, high wage earners max out on their defined contribution plans. So they start socking money away into the non-qualified because they can. Anybody can. Now you can also own an annuity in a Roth IRA, and you can also convert a tax-deferred annuity into a tax-free annuity the same way you would convert any investments. You do need to check with the carrier, whichever company you go with, but because they have some rules about how you do it, but most of them do allow you to convert a qualified annuity into a tax-deferred annuity into a Roth or tax-free annuity. Now you're really, you have to pay your taxes on it, but everything that comes out of it is tax-free at that point. Riders. What is a rider? Okay, well, the insurance company, they're in the business of insurance, and you get to choose. It's just like homeowners. Homeowners, I find complex. Well, do you want replacement value or market value? Do you want an earthquake rider or no earthquake rider? It's like there are a lot of choices just for your homeowner's policy. How much are your belongings in the house? What are they worth? So insurance companies obviously say, well, you can add a death benefit rider where you can ensure that your beneficiaries will have something to inherit when you die. The guaranteed income for life is a rider. The difference is some carriers don't charge for it and some do. Inflation protection, again, a lot of annuities now you don't have to pay for inflation protection. It comes as part of the core product. We talked about the well-being. This one you do have to pay for, and they'll usually charge 1% per year, anywhere from 0.5% to 1%. So if I get an annuity that has the guaranteed income and inflation benefit, and I don't pay any additional fees for that, I may, depending on my personal unique situation, want to add on a death benefit protection for my children. I would probably, if I didn't have any long-term care, I would definitely add this benefit. And even if I had long-term care, I may want to supplement it. Okay. So suitability. Ooh. Annuities are really best for people who are retired or within, I would say, I call it striking distance, right? 10 years or less, within 10 years or less of retirement. But for people who, for whatever reason they don't want to lose principal. They could use a pension-like paycheck every month. They want market growth, but they don't want the risk. So they're willing to take the cap. Some people, I've had clients buy an annuity because they did not qualify for a traditional long-term care policy. There's no underwriting. There's no underwriting for annuities. It's an investment. This is something that I've used for years, and I'd like to say I came up with it, but I can't remember where I got it. So I'd like to take credit for it, but I can't. I always ask investors, what's your SLY factor? What's your SLY rating? So if I were working on a scale of 1 to 5, where 5 is the highest level, how do you feel about safety? You know, if you're the kind of person that only puts money in FDIC insured products, you're going to be a 5, right? You're going to say, you know, I really want safety, 4 or 5. I actually think for annuities, this could be a 3 to a 5. Liquidity, now that's something. Annuities, and I don't know if I actually addressed it here, and I probably should dedicate a slide to it. If you put money into an annuity, there are high surrender fees. For example, if I buy a 7-year annuity and I want all of my money back in the first year, I'm going to pay a 7% surrender fee. But the carrier will let me take 10% of the annuity without any penalty. So follow me here. Let's go back to the woman or me who puts $300,000 into an annuity. And I don't expect to take income for 5 years. And then an emergency happens in year 2 when the surrender fee is 6%. It goes down 1% every year. If I wanted my entire amount back and it hadn't grown at all, I would pay a penalty of 6% on $300,000, $18,000. That's very high. So I caution people, you know, have your emergency fund. Don't put all of your eggs in one basket, and clearly don't put money in this annuity if you're not prepared for an unexpected life event. So liquidity, I would say, you know, if all your money had to be available immediately, I would not buy an annuity. But if it's part of an overall portfolio, then yes. If you can, you know, if you can get access to funds somewhere else, then yes. I mean, I've seen people put $2 million into an annuity. Now they could take 10% a year without penalty. And I guess $200,000 for them is fine because maybe they had money elsewhere. In terms of yield, you're always going to want the highest yield, but in reality, you can't have the safest product with the most liquidity with the highest yield. You can't. That's what we call the risk-reward ratio. The higher the risk, the higher the reward. The lower the risk, the lower the reward. So, you know, if you're okay not in this particular investment, not getting 20% when the market's up, you're okay with getting 8% with zero downside risk, then you would want to look at an annuity, right? So SLY, how do you feel about safety? Are you risk averse or willing to take chances with your money? Can you afford to take chances with your money? That's very different than mentally, will you take chances? Liquidity, all right? How does this annuity fit into your overall portfolio? And will you have to take more than 10% from this? Now, in my example of a 7-year annuity, by year 8, I have no surrender fees. I can take the full lump sum and I can leave. No penalty, no fees. And yield, annuities today are guaranteeing 5-6% for certain periods of time. Yes, 5-6%. That's an incredible return, but you have to deal with, you know, liquidity and other issues. And you could also get more in the market if your timing is right and you're lucky. And timing and luckiness are two things that I really never like to talk about when we're talking about investing. Yeah, because you really want to make informed, educated decisions and not base anything on timing or luck. Okay. So what are the fees? What is all this product cost, right? Well, it depends on the type of annuity. Variable annuities really gave annuities a bad name. Their fees are very high. I actually own a variable annuity, and I'm sure I pay about 4% a year. A lot of people have a hard time with that, but it's worth it if you know what the benefits are. Fixed annuities are comparable to investing in ETFs and mutual funds, and really you can get annuities, fixed annuities for 0 or 1%. So, but when you hear people talk about annuities in general, probably talking about variable annuities. Honestly, they're not talking about the fixed indexed annuities. They're complaining about the high fees of variable annuities. And I admit they are high, but you can't take it out of context. You know, you need to look at what are the benefits. And the people, the naysayers of annuities, they also don't point out that the guarantees are net of fees. So, if I'm guaranteed 6% per year for the first 10 years, and the market, does 8% or 6.5%, let's say, I'm going to get all 6%, even though my fees would have taken me below 6%. Your rider fees are separate and usually cost an additional 0.5% to 1.5%. Sales commissions. Sales commissions are paid by the insurance carrier, not the purchaser of the annuity, and they typically range between 5 and 7% of the premium. $100,000 annuity would kick off $5,000 to $7,000 to the company or advisor agent. Now, if the advisor agent works for a company, they're going to receive generally 1/4 to half, right? So if you say you have an advisor with a large investment company and you buy a $100,000 annuity, that might kick off $7,000 to the advisor. The advisor shares it with his or her company. He or she may get $3,000, $3,500, and the company gets $3,500. But this is all paid by the insurance carrier. Now, the large institutions are a pay-to-play marketplace, and I don't want to go into detail on this, but it's a large reason why I no longer work for the large companies, because they sell the products of large carriers that will pay them more than this, more than the $5,000 to $7,000 to offer their products. Now, just kind of projecting who the haters are, the fee-only advisors who really dislike annuities. Well, they dislike them because they have no way to get paid on them. This is changing. Insurance carriers really want to tap into the fee-only advising business. So they're coming up with fee-only annuities. And these are annuities that can sit inside a wrap account or a fee-only account. Let's say you're paying your advisor 1% of your assets under management. You have $1 million with them, that's $10,000 a year. Right now, most of them cannot put an annuity inside that account. They can only deal in mutual funds and stocks and bonds and ETFs for that 1% per year. Until they can purchase annuities and get paid, until they can get paid on until they can get paid on insurance products, they're not going to offer them. And it's as simple as that. Whether they're good for you or not, whether they fit into your portfolio or they don't, they cannot offer these to you. Right? Okay. What's the risk? Well, listen, you got to pick a AA, AAA insurance company. Just like when you buy a bond, in that advisor only fee account, that fee only account. If you buy a Coca-Cola bond, well, you're basically, depending on the full faith and credit of that company and its ability to pay you back. It's no different. It's no different whether you're dealing with an insurance company and annuity or an individual company and a bond. The full faith and credit of that company and its ability to pay you back, pay you the annuity payments. Now, each individual state in the U.S. has a guarantee association that was set up specifically to protect annuity and life insurance policyholders. You're a policyholder when you own an annuity. And We have just a few cases of large companies, large financial carriers going bankrupt. So the State Guarantee Association in Virginia, so each state has a different amount. In Virginia, we cover each annuity investor up to $250,000 for each carrier. So similar to when you're working with an FDIC product and your banker says don't put any more than $250,000 into each account because FDIC won't cover you. Same with an annuity. Your State Guarantee Association will cover you should that company go bankrupt. From a historical perspective, we have several that we can look at. Executive Life Insurance was a company that went bankrupt in 1991. AIG, went bankrupt. Well, they would have gone bankrupt if they weren't bailed out by the American Federal Reserve, right? The Fed bailed out AIG in 2008 during that crisis, up to $200 billion. But had the Fed not bailed out AIG, the owners of the policies here could have gone to the Virginia state and received up to $250,000 for each annuity that they owned. I actually think that that's more protection than owning a bond from Coca-Cola. If you stick with your AAA, I mean, it has more protection. I'm not saying the company's higher quality or less quality, but if you buy bonds, there's nobody that's going to guarantee you any amount should that company go bankrupt. So, considerations: principal protection. Your growth is limited with a cap or ceiling. You can get guaranteed income for life, of course, backed by the full faith and credit of the insurance company. You can decide how much money you want left for heirs. You're indexed to the market. If you'd like some long-term care coverage or want to supplement an existing policy, the benefit is there for you. A very key consideration is there's no underwriting. As I said, I've had clients that want long-term care but would not qualify, could not be underwritten. So they purchased an annuity that would double the payment. And you're basically transferring the market and longevity risk for a fee. Right? It's a very simple construct. Okay, now let's get to the fun part, the annuity haters and why they hate annuities, right? And I see my little jumping title. Fisher Investments, let's make no bones about it. I Google what is an annuity, and the very first entry, their search engine optimization is working really, really well. Learn some of the startling facts about these complex investment products, right? Don't let the word guarantee fool you. It's out there, and it's marketing. I assure you, anybody can write an article and bash anything. It doesn't matter whether you're talking refrigerators, investments, cars, opinions. We basically can disagree with anything. And if we're smart enough, we can write an article to convince people. It's marketing, okay? What is an annuity? And I get, well, don't let the guarantees fool you. Beware, beware. I actually read their article, and I could probably offer an entire class going on, walking through Fisher's 10, 20-page annuity bashing article. But they basically say, well, it's a compromise, right? Let's take a look at if I have my money in an annuity and not in an annuity. So option one is the investment. Option two is the annuity, the indexed annuity. They're saying, look at this. I will have $2 million left on average at the end of my life versus having $818,000 at the end of my life. They give me a rate of return that's 1% less than what they can get me in the market. Now for them to get me 5.7, if I'm paying them a 1% fee, that means they're going to get me 6.7. They're going to get me consistently 6.7 per year for the rest of my life. And when I subtract their 1% fee, this is what I get. I really want to open this up for questions. So let me just say that, look at this little hidden paragraph. Keep in mind that during market downturns, people can always decide to cut back on their discretionary spending until things have recovered. This would enhance the survival probability and the ending value of the portfolio. So let's just put this in the context of the virus today, the COVID-19 virus. You know, if you're taking money out of the market and that's your only income, can you decide to cut back on your, is it discretionary spending that you're cutting back on, or is it groceries that you're cutting back on? So suffice to say, you've got to really do your own education. You have to understand the product. And with very, very super duper marketing techniques, a person looks at this and says, oh, I would rather have the 4 million than the 2.7 million. Sure, I would too. But I have to put it in the context of all of the other benefits and the risk and et cetera. Then you go to a simple, you know, Fidelity, very reputable in the industry. What are annuities? Oh, give us a call, we'll talk to you. Let me tell you what they are: saving for retirement, approaching retirement, and living in retirement. You know, go to another reputable carrier, and they'll tell you all about it and let you decide whether or not it's right for you. Of course, they want you to call them, and that's fair. Annuities versus bonds. You get a regular payment. Payments are backed by the insurance company. The insurance company has ratings. Bonds give you regular dividends. Payments are backed by the company issuing the bond. The company has ratings. Quality companies offer lower bond dividend rates. Junk bonds offer higher rates of return, but the companies are rated below -B. There's a dichotomy with annuities. Annuities right now are actually similar to a quality company offering a junk bond yield. The yields are higher, right? A quality bond is going to offer 2 to 3% right now. Quality annuity is going to offer 5, 6%. Also, the price of the bond goes up or down depending on interest rates. So if you're holding bonds in your portfolio right now, the value of the bonds have gone down as interest rates have gone down. So if you were to sell them, you would lose. Rates are clearly down right now, right? Where we were 30 years ago, 20 years ago, 10 years ago, based on where we are today. Here's what a AAA bond yields: 1.3. Junk bonds, you can get 5 and 6% return, but they're offered by companies that do not have a high credit quality. Right? There's more risk in these bonds that they may go out of business. How do we decide? The markets, we know they'll come back, but we don't know when. Interest rates, they have nowhere to go but up. Inflation, probably more like a recession. Tax rates are at a historic low. Like interest rates, really nowhere to go but up. Is it right for you? What's your slide factor? What type of ask these questions when you are considering an annuity and you're sitting down with somebody. What types of indexes can I use and when do they reset? What are the caps or ceilings on my gains? When can I take income and for how long? What percentage of my total savings should be in this investment? What am I comfortable allocating? What are the fees? What other riders or benefits are available? What do they cost? What is the insurance company rating? Please only stick with the AAA, AA's companies. Educate yourself like you're doing today. Talk with a reputable, trustworthy financial professional. Thank you very much. I'm going to open it up for questions. If anybody's still on the line, I've gone a little bit, I think a few minutes over. No, actually, no, I think we've still got 10 minutes, but I'm happy to stay on as long as you like. This is my website. Please visit, subscribe, ask me a question through a contact us. You can even schedule a 15-minute or 30-minute meeting with me. As I get more subscribers, I'll probably reduce that to just 15-minute meetings, but we'll see. I've got to walk before I run here. I'm also going to hold more educational workshops. The next workshop will be held next Tuesday at this time, and I'm actually going to walk you through an illustration. If I can create a survey today, I will send you a survey. For those of you who know me from the class, you know, I've taken this time of the quarantine to really focus on financial education, and this is my first shot at putting together something online, a virtual. I'm very used to doing things in person. So with that, we'll see if I can open it up for people to ask questions. And I certainly hope I can do this. Okay. Does anybody have any questions? Did I do that well of educating here that I don't have any questions? Or are you muted and you can't ask a question? Okay. Well, listen, I don't know if it's a technical problem or you simply have no questions, but I am here. The webinar may actually say that my name is Shirley Liu, but it's not. I'm using Shirley's webinar, GoToWebinar. This is Lynne Celia, right? Thank you very much for joining me today, and I hope to hear from you in the future. Everybody stay healthy, stay well, and stay calm. I'm giving a wellness workshop this Thursday through the Fairfax County Library system. You can go onto my website and you can register for that, but it's really about financial wellness, how we can remain calm, and some of the things that we can do financially during the crisis. All right. Thank you so much. Take care and stay well. Bye-bye.